director of the BC Centre for Social Enterprise, and since 1996 she's run her award-winning tax service and bookkeeping service called The Right Stuff. And we're very pleased to have her, and with that I'm going to turn it over to Stacey Corriveau. All yours, Stacey.
Thank you so much. This is my first time using the software, but it looks like it's going to go smoothly. Hopefully you're able to, oh, it's just coming up now. You're able to see the handout. So I'll be, hopefully I have control of the handout, and I'll be able to scroll down and show you where we are. Also at the bottom left-hand side of your screen where it says web links, you'll be able to click on any of these links to see more information on the topics that I'll be talking about this afternoon. So let me just do a test here, and yes, I do have control. So good to have control. Okay, so the first thing I want you to take note of, if you could, is the CRA website, Canada Revenue Agency. For those of you who have not been to the site in the last few years, it has improved dramatically. It used to be quite user unfriendly. But now you can basically find anything you need to know on this website. It's very easy to navigate. If you haven't already, make sure that you bookmark this website. So as our introducer said, I do have a bookkeeping company, and I actually do this for fun. This is what I do to relax. So hopefully I can make this more exciting than you're expecting the topic to be. It tends to be a dry topic, but I hope maybe you'll have a change of heart after the next hour. So you'll see on the handout right at the bottom of each page is my email address. If you have any specific questions that we're not able to answer during this session, just flip me a quick email and I'd be glad to answer your question for you. The first thing I want to call to your attention, because the overall context of this session is entrepreneurs with disabilities, is this special program. If you are listening, or if you're a bookkeeper and your clients have the disability status with the province of BC, it's very interesting, very imperative that you become aware of this program. It is called the self-employment program, but it's probably not what you're expecting. Typically, we have self-employment programs that offer mentorship, classes, and networking. This is not that type of program. It is simply an income reporting program. So you might think, what's the point of this? It is super important that if you are running a business or considering running a business and you have disability status, that you get in touch with this program. Run, don't walk. It's basically registering your business on the program, and once you're registered, you will be able to claim business expenses against your disability. So if you did not apply for this program, if you're not registered, then not only would the net profits be clawed back from your disability allotment, but the expenses would not be accepted. So that means that you'd probably be out of business in short order. So put another way, if you are registered for this program, and again stressing this is only for folks who are collecting disability benefits, once you're registered, then the program recognizes net profits as opposed to gross sales. So that might maybe become a little bit clearer when we talk about business expenses, but if you are not registered for this program, they will not accept your expenses. They'll just accept your gross sales. So you would never want to be in this position because you'll probably get most of your disability allotment clawed back. So there's a link here, very, very important to communicate to this program if you are considering business and you're on the disability. Okay, so that's all I wanted to say about that. I just wanted to draw it to your attention. It's not really part of the topic that we're going to be covering today, but I wanted to point it out to you. So the topic is tax tips for sole proprietors. We're going to assume that the folks listening have sole proprietorships. I won't be saying much about the other business structures that are available to you. And it's tax tips in the sense that I firmly believe that if people don't understand what they can write off and what they can't write off, then they're probably going to be paying more tax. So the point is to understand the range of expenses that are available for you to apply against your business income so that at the end of the day, you're paying less tax. This also means being a little bit organized and keeping a hold of all of those pesky pieces of paper that are in our lives, all those gas receipts and the receipts from the office supply store, and in most cases our home bills as well. But I can guarantee you that all of that work is worthwhile in terms of the tax savings that you will enjoy. So the first section of the handout is the bottom of page 2, and it says a little bit about tax filing deadlines, tax rates, and fiscal year ends for sole proprietorships. So very quickly, a sole proprietorship and the person running the business are one and the same, so there is no legal distinction. My bookkeeping business is a sole proprietorship, so that means from the perspective of income tax, I'm filing the activities of my business on a little worksheet called a T2125, and I file that with my regular personal income tax. There's a link here on this presentation that will take you to the 2125, and it looks a little bit overwhelming at first. It's about 6 pages, but really the whole point of that worksheet is to simply state your business sales and subtract your expenses. That's all there is to it. And of course, the name of the game is trying to get as many expenses listed in that worksheet as possible, because that's going to bring your taxable income down. Taxable income means the income that you're paying income tax on at the end of the year. I will quickly refer to corporations. They are seen as distinct legal entities. They're not viewed as one and the same as the business owner. So they have a separate structure, separate tax rate, separate tax filing deadlines, and a lower tax rate than sole proprietorships enjoy. Why would you not start a corporation? They're more expensive to start. There is increased reporting, so you would be paying more to an accountant year after year. So it's just that added cost that you need to weigh against, are those tax savings an overall benefit as compared to the ease with which you can start and run a sole proprietorship. Many small businesses are sole proprietorships. And you can run more than one if you're doing more than one activity that is distinct. So for example, I run a bookkeeping sole proprietorship, and I also run a consulting sole proprietorship. And both of those have a T2125 on my personal tax return. They have 2 separate worksheets, one for each business. So when I talk about net profit, I'm talking about your sales in your business minus your expenses. And that is what you're paying tax on. So you're not paying income tax on your sales. That would be horrible because you want to subtract your expenses from those sales, and then you get to a lower amount, and that's what you're going to be paying income tax. So if you're running a sole proprietorship, when you get to the bottom of your 2125 worksheet and you come up with that net profit, then you're going to bring that forward to the main jacket of your tax return if you're doing your own taxes. And that income will be added to any other sources of income that you might have personally. That could be wages if you're doing other work, employment work. It could be investment income, rental income, pension income, etc. That all of those incomes are lumped together and taxed at the same rate. If your expenses exceed your sales in your business, then you have what's called a net loss. That net loss is also carried to the front of your jacket and actually serves to reduce your total sources of income. So say you had 3 different sources of income and one of them was a business that was showing a net loss. That would bring your total taxable income down, so reducing your taxable income. Now, I wouldn't want you to think that showing a net loss year after year is a righteous business goal, because of course you don't want to be running a business into the ground. And after a few years, you will get a call from the Canada Revenue Agency asking you what your intentions are if you're showing a consistent loss year after year. That said, if it's a new business, then CRA almost expects you to show a loss for the first year. They're expecting that your expenses will be higher than your sales. This isn't always the case, of course, but you want to just know that you're under no particular pressure to be showing net income in your first year of business from the perspective of Canada Revenue Agency. So I've listed here on the top of the next page the income tax rates for sole proprietors. I promise that the content of this webinar will get more exciting than this, but I just wanted you to have this in front of you so that you can see that in Canada, we have sort of a stepped income tax regime. So you can see that the income tax rates increase the more money that you're making. So you can see it's 15% on the first 43.5 and then up to 22, 26, and 29. So the more you're making, the more you're paying is the general rule of thumb. And I also have a little note for you here in these handouts to remember that a certain amount of income is tax-free. It's called the basic personal amount. So 2014 rates are not out yet, but for this year, the first 11,000 or so is tax-free. And if you have a disability amount, you can add about $7,700 to that. So we're only talking about after those amounts are exceeded, would the income tax kick in. I've also listed below the federal tax rates, the British Columbia rate. So we are paying both rates of income tax here in BC. If you were in Ontario, you would be paying federal plus the Ontario rates. One little caution area that I'd like to point out is the Canada Pension Plan. So if you are not considered to be disabled under the CPP, you would be subject to paying CPP within your business. So the interesting part that I think not too many folks recognize is that in a sole proprietorship, you are considered to be both the employee and the employer. That means that you need to pay or set aside both the employee and the employer's portion of CPP. So you want to be estimating what your net profits would be at the end of the year, and you want to put aside roughly 10% of your net profits for CPP. The cap for 2013 is $4,700, so that would be the maximum that you would have to put away for yourself. That's both the employee and the employer total. So $47,1240 would be the total maximum that you would need to put aside. And when you take a look at your personal tax return in the very bottom line there on page 4, you're not only paying income tax on your tax return, you would also be paying the CPP at that point. So that's when it would be assessed. When would that be assessed? Because as sole proprietors, ourselves and our businesses are one and the same, and we're filing on our personal income tax return, our fiscal year end for our sole proprietorship is always December 31st, because we're mimicking the personal year of our personal tax return. So your business year would run January to December, unless you started partway through the year. In that case, for that first year, you would be running what's called a stub year. So say you started on June 1st, then you would have a 7-month stub year that goes to December 31st. And from that point forward, your year would be January through December. So when is your CPP due? It's due when your tax return is due, because you're submitting it all at the same time. When is your tax return due? Well, we're all accustomed to the April 30th filing deadline of our regular personal tax return. There's a little bit of a bonus here if you're running a sole proprietorship, in that you have until June 15th to file your entire personal tax return. Don't get too excited. If you owe income tax, interest will start to accrue on May 1st. So if you know that you're in a refund position on your taxes, then of course take that extra 6 weeks you have until June 15th to file your tax return. This also applies to spouses of the sole proprietor, regardless of whether or not that spouse is involved in the business or not. So again, you would need to know whether or not you owe tax to see whether you should be benefiting from that extension. I'm seeing Gary, I think you're on mute.
Yep. Hi, I've got a quick question for you.
Sure.
If a person is already collecting CPP, do they need to pay that CPP as a sole proprietor?
No. So that's a great question. But having said that, we're seeing some really sticky situations for folks who have taken CPP early. And I would recommend that you talk to an accountant about that. If you are, say, between the ages of 60 and 65, we're seeing really scary situations in the accounting world where folks are thinking that they're CPP exempt. They actually are not, and it really comes back to bite them. But if you are CPP exempt, either through age or through disability, no, you do not need to be setting aside that CPP. I hope that answers your question. Does that answer your question? If not taking early, the question from Michael is, yeah, that's the situation where you need to check in with your accountant, because it's the taking the CPP early that we're finding these really sticky situations where you need to file some paperwork with the government and make sure that they actually receive it, because we're also finding that the paperwork is getting lost. The person thinks they're exempt, that they've opted out, but the government doesn't have any awareness of that exemption. So we have a question here. If you have not reached the ceiling on CPP contribution. So the ceiling is at $4,700 for the year. So you would owe up to that point. So it's 4.95% if you want to know the percentage, the way that it's calculated, of your net profit up to $4,700. And then you double that to roughly 10% because you are responsible for both the employee and the employer portions. So up to 4,700, but if you're generating less revenue than that, then you would apply those percentages. So 10% is always just a good rule of thumb to that max of 4,700 for 2013. There's a comment here about how the rules keep changing. And I do have a few people on payroll, so this is getting out of self-employment, that were exempt, and now they're finding out they aren't, and so they're having to pay back into it. So the rules changed roughly a year ago on that early opting out of CPP. So I'd like to move on now, if I could, to the basic expense categories. And so the reason I'm going to be spending some time on this is to make sure that folks understand what is available for them in terms of write-offs. If your business is a GST registrant, so that is, if you are charging GST to your customers, you don't want to include the GST in your expenses because you're going to be claiming those back. So say you have a printer cartridge and there's GST on it, that GST is going to be claimed back in what's called an input tax credit, and you would only count as an expense the item without GST. So in the case of the printer cartridge, you would count the cost of the printer cartridge plus the PST, which you cannot claim back, but not the GST. If you are not a GST registrant, that is, you are not charging GST to your customers, then you would include your GST in your expenses since you're not entitled to claim it back. It's not in the notes, but I want to do a little mini rant here about when or whether to register for GST. And some people from the Community Futures world who know me, who are listening right now, probably can guess what I'm going to say. My opinion is that too many small businesses are warned against registering for GST when they really should consider registering. So the item that I'm referring to here is the $30,000 small supplier threshold. That is, if your business is generating less than $30,000 in sales in 4 consecutive calendar quarters, then it is not compelled to register for GST. So what I see are a lot of small businesses waiting until they hit the $30,000 threshold to register. In my mind, there are a couple of downsides to that. The first is optics. If your business is not charging GST to your customer knows that you're a small business generating less than $30,000 a year. So if optics concern you, if you would like to appear a little bit more established or larger than you are, then charging GST would be a way to mask the size of your business. The other rationale, which I think is even more important, is if you are a GST registrant, you are able to claim back the GST that you pay in your business. So in other words, if you are not a GST registrant, you are throwing away 5%. That 5% GST you can claim back when you file your GST returns. Some folks might think that they don't want to charge GST because they don't want to charge the client an extra 5%. And my comeback to that is that we are all accustomed to charging GST, so you will likely not lose a sale because you're charging GST. The GST that you charge is not money out of your pocket, it's money out of your customer's pocket. That money is being held for the government, and then you are deducting the GST that you have paid in your business. So you only pay a partial amount of that remittance to the government. So especially if you're starting out your business, you will probably have more outlays like computer equipment, other machinery, promotional items, office supplies that would all have GST in them. And if you're waiting until you hit 30,000, you won't be able to claim all of that 5% that's scattered across your startup costs. I will stress that if you do choose to opt in under 30,000 as a GST registrant, you must charge your clients GST. So you can't have it both ways. You're either all in or you're all out. So others would think that it's just they don't want the hassle of having to file GST. That's fine. That's a legitimate reason. I won't say excuse. I'll just think it. I would argue perhaps back to that if you are a quarterly filer of GST, in a sense, that structure forces you to be up to date with your bookkeeping every 3 months. So it's a good little nudge to have in place just to keep on track of where you are in your business. I know so many of my own clients who come to me and they're not charging GST, so everything just goes into a shoebox all year because there's really no compulsion for them to get on top of their books. And as a result, they have no idea where they are in their business. They have an intuitive sense, but beyond that, they haven't really quantified their sales and their expenses. So that's just my little rant on GST. Any questions on the GST before I move into specific expenses? Capital versus expense limit is a question. I'm not sure I understand the question, so if you could expand it for me, I would appreciate that. So as I move into expenses, I'm going to say up front that the expenses related to home office and car are quite unique, and I'll be speaking to them at the end of the presentation. So if you have any questions about home office or car expenses, also amortization of assets, I will get to that at the end, I promise you. So the question is, what is the limit for expense items before they are considered capital costs? I'm just about to get to that, so if you'll bear with me, it's a little further down in my presentation. So I've listed some of the basic expenses, and if you're not using bookkeeping software, you might just want to keep file folders with these categories so that you can place your paperwork into these file folders. These are the names of the expenses as per Canada Revenue Agency. So if you're calling these expenses something else in your business, at the end of the year, you're still going to have to translate them into CRA language. So I would advise that you just get into the habit of using their language. That way you don't have to do a big translation at the end of the year of your language into CRA's language. So the first is advertising. And so this is not only an account for the traditional advertising that you might think about, such as print ads, but it's really for anything you do to promote your business. So think pens, calendars, anything with a company logo, gift certificates, flowers for clients, chocolates for clients, flyer printing, anything like that, anything that is furthering the promotion of your business, you can go ahead and count in this category. So the next one is business tax, fees, licenses, dues, memberships, and subscriptions. So you see that that's a catch-all, and you will put your annual business license in here. A side note about business licenses, if you're doing business, you must have a business license. So it doesn't matter whether your business is tiny or seasonal, or whether you are selling brownies out of a church basement. If you're doing business, if you're generating sales, then you do need to get a business license. This has nothing to do with CRA. This has to do with municipal requirements. So one does not touch the other. CRA will not come after you for not having a business license. It would be the municipality that you would be dodging on that. And depending on where you live, you could expect to pay around $120 a year for a business license. So your business license would go into this category. If you have like a chamber membership or belong to a board of trade, would go here. If you subscribe to business-related magazines or publications, would also go on this line. I'm just reading a question here. There is, to answer the question that John has asked, there is a link that's in the web links to screen that talks about how to bring assets into your business if you already have those assets. So it has to do with reaching the fair market value of those assets and bringing them in at that amount. But I urge you to take a look at that link and you will get your question answered there in more detail. The next category is insurance. So this is not home insurance, it's not car insurance, because we'll be talking about that a little bit later. It's property insurance if your business is located in a commercial space. It could be liability insurance for your business. As a bookkeeper, I hold errors and omissions insurance, and so that would go on that line in my case. Moving on to interest, you might also want to think about this as bank charges and interest. This is where we put our monthly bank service fees. It's not for mortgage interest for your home. Again, we'll talk about home expenses in a bit. It's if you have a mortgage on a commercial space, then you would put the interest there. Or if you have a business loan or line of credit that you're paying interest on. So this is all related to your business. If you pay a lawyer or an accountant or a bookkeeper, this would go on the next line, legal, accounting, and other professional fees. So again, these are all lines in the worksheet called the 2125, where you're going to be reporting at the end of the year on your activity. Maintenance and repairs is not for car or home repairs. It would be if you had, say, your work computer and you needed some IT work done on it, or you had special business equipment that needed some repairs or maintenance, it would go in this line. So meals and entertainment is an interesting one. The fundamental thing to remember is that we all have to eat. So I'm thinking of a client right now that I'm working on, and I'm seeing every meal that these people have. I'm intimately familiar with where they eat, where they go to eat. Could be up to 2 meals a day every day that I'm seeing. And when I see that, I know that that is an audit flag or an audit trigger. Just because you're in business, it doesn't mean that we get to write off every meal that we have. So remember, we have to eat. So we don't get special tax benefit for eating. What we have to remember is that the meals that we can write off are business related meals. So this has tightened up quite a bit in the last little while in terms of CRA's viewpoint. It used to be, for example, as a bookkeeper, when I'm out on the road, say I have a client in New Westminster, I'm in Abbotsford now, I can't come home for lunch. So I would go to the local sushi place for lunch, grab some sushi, and go back to my client. I used to be able to write that off quite confidently. Now the way that we're seeing the opinion of CRA going is that because I wasn't eating that sushi with a client, because I wasn't at a business meeting, I actually cannot expense that meal. So if you want to operate by the letter of the law, you want to be thinking business meals in terms of taking someone out, having a business conversation, taking out a potential client, a current client, a supplier, etc. So it wouldn't be going out yourself and grabbing a meal. And I mourn this personally because I'm a Starbucks girl and I think of all the Starbucks that I grab for myself in the course of business and really feel that I can't freely write this off anymore the way I used to. Keep in mind that with meals and entertainment, whatever amount you have at the end of the year, say it's $1,000 in business meals, you can only take half of that amount. So again, the idea is that we have to eat anyway. And so if it's $1,000, only $500 can be claimed. This is called the 50% rule as it applies to meals. And because of this, I'm getting, I'm reading the questions at the same time, so I should stop doing that. I'm getting off track here, jumping ahead of myself. So because of that 50% limit on meals, if you are a GST registrant, you can only take half of the GST on that meal to claim back as an input tax credit. So that 50% applies both to the expense and to the GST associated with that meal. And there's also a little note here at the end of this section that you can expense at 100% up to 6 staff events per year. So think Christmas parties or summer barbecue, events like that, you can pull at a rate of 100%. The idea being it's almost more of a promotional expense than a meals expense, but the limit is 6. There's a question on the screen about what percentage of internet expenses you can claim for a home-based business. I'm going to get to home expenses towards the end, but I will quickly say to that question, I usually advise clients to claim all of their internet because they need internet to run their business. So it isn't like hydro or some of the other home expenses that you take a percentage of. You're in business, you need internet. It's almost incidental that you would also use it for business or for personal use. You need it for business, write off the full internet. There was a question before about a limit on at what point do you have to capitalize or depreciate an item, and at what point are you allowed to expense the whole thing. So you'll see in my notes that I have $300 as the limit. This is a discretionary amount. So this is the amount that in the accounting offices where I work, they use $300 as the limit. Some use $500 as the limit. You're not going to be able to find a number on the CRA website. The underlying idea is that it be a reasonable amount. So what we're talking about here is if you purchase, say, a printer for your office, since we're in the topic of office expenses, and the printer costs $299. If it were me, I would write off that as a full office expense in the year that I purchased it. If I paid $301 for the printer, I would depreciate or amortize that printer over time. And I will get to what I mean by that a little bit further on in the presentation. What do I mean by amortization or depreciation? But it basically means that the item stays on your books for longer than the year because you're going to continue to derive benefit from that printer beyond the year. So again, $300 is discretionary, okay? And the same goes for supplies. Everyone's supplies account will be as different as any other business. So if you're a soap maker, for instance, you would have measuring cups and pots and pans and spoons. As a bookkeeper, my supplies are office supplies, so I don't even really keep a separate account. I put everything under office expenses. So these are items that you use for your business that you are not reselling, but that you need in order to carry on your business. Purchases are a little different. These are items that you do intend to resell to the client. So say I have a candle company and I'm purchasing wax and wicks. This would go under purchases, not supplies, because I'm going to be reselling these. The important thing to note about this is that if you are in a business that is selling a tangible item, that you cannot expense those items until the year that you have sold them. So that's a really important note. When we hear the idea of inventory, this is why we're keeping an inventory. We only get to write off the item in the year that we have sold that item. Property taxes for home-based businesses will not be used. It is if you have a commercial property for which you are paying property taxes. The same for rent. If you are renting a commercial property, you would use this line. If you're renting your home, you would not use this line. And we'll get to home expenses shortly. I have a lot of advanced questions coming up on the screen. The one is on the form 2125, do you choose business or professional? Most people choose business. Professional is if, say, you're an accountant or a doctor and you happen not to have a corporation, which would be rare. Most of us would choose the business form. If you are a sole proprietor and you have no one on staff, then you do not have payroll. So this is because you and your business are one and the same, so you're not viewed as a staff member of your sole proprietorship. If you were incorporated, then you would be a staff member of the corporation. If you have staff on payroll, that is people who are not you, but other people that you've hired, then you would have a salaries, wages, and benefits section on your T2125. I also put my WCB or WorkSafe BC payments on this line and the employer's portion of EI and CPP. Again, this is if you have staff on payroll in your sole proprietorship. The travel line is really like planes, trains, automobiles. It's not your own car. It could be a car rental. It could be buses, ferries, taxis, hotel rooms, airfare. 2 conventions per year is the CRA limit. Telephone and utilities. So we just had a question on the screen about how we're claiming, I presume, our home phone. The argument is a little bit different here. CRA, their position is that you would have a home phone regardless of whether or not you have a business. So you cannot write off your home phone within your business. You can write off your cell phone, or if you have a pager, if you have a business fax line. We have internet connection listed here. But if you have only a home phone, you would only be permitted to write off or expense your business-related long-distance charges. I hope I'm keeping up with the questions here. So as promised, I'm going to talk now about some of the special expenses. And I say special because we just have to think about them a little bit differently than simply listing them on a line as we have for the other expenses. So the first is amortization, also known as depreciation. And this is that whole idea of the item that costs more than $300 per unit and that we're going to be deriving benefit from beyond the current year of business. There are many different classes of property. I think there are around 50 different classes of amortization. I've just listed here in your handout the three that are most commonly used here. So the general equipment and furniture, automobiles, computer hardware, and software. So you can see that they have different depreciation rates. The idea being that these items depreciate over time at different rates. So you'll see that computers are quite high because they're basically obsolete the minute we take them out of the store. So CRA recognizes that and allows you to write off a larger proportion of those assets over time. Just when you think you have that straight, I need to point out that there's something called a half-year rule. CRA put this into place because people were going out on the last day of the year and buying lots of assets so that they could depreciate them. So the half-year rule dictates that for the year of purchase, no matter when in the year that occurs, you can only take half of the amortization rate for that year. So if it were general equipment, then you could only write off 10% the first year and then 20% for every year after that. So again, you might think you have that all straight until you see my example. So we might think that something that is depreciable at 20% of the year, let's take away the half-year rule just to keep things simple. We might think that that 20% item would be written off in 5 years. 2020, 20, 2020 equals 100%. That's actually not the way that we run amortization. The way that we do it is we take the rate on what is remaining. So it will never be zero. I've taken an example of a $1,000 table and I've showed you what it looks like over time when you first take your 10% the first year and then 20% thereafter. So you're taking 20% of what remains. So this could go on for infinity or until you're no longer using the item, it breaks, you get rid of it, you sell it, then it comes off of the books. If you are using an accountant to prepare your tax returns, you don't need to worry about the mechanics of this, but just understand that behind the scenes, the personal tax software is taking care of the amortization in this way. I would like to stress that amortization is an optional expense. So that means if you don't need it in the current year, that is, if you've started your business and you have way more expenses than you need and you're already showing a loss, you don't have to amortize that table this year. You can start amortizing it next year, which means that over time, you'll have more asset to amortize. So this is a discretionary expense. There's a website here that's on the CRA site that can show you all the details on amortization and way more classes of asset than I've detailed here.
A quick question, Stacey. Are you able to amortize manufacturing supplies? That comes from John in the audience.
If you're meaning equipment, then yes. If the item is less than $300 per supply, then you can just expense it. So in manufacturing, we mainly see equipment being amortized because it costs more than $300 per unit. I'm going to move on to business use of home, taking a look at the time. Most of us run home-based offices at least, or we might have a larger part of our business based at our home base. So the idea here, and I was just talking to a realtor who hasn't been doing this, and I just think about all of the expenses that she might have taken advantage of over the years. The point is that you are allowed to take a percentage of all of your home expenses, and that percentage relates to the amount of space that you have devoted in your home to operating the business. Now note here that if you're using a space that also doubles as home use, so say for example, you are packaging candles on the dining room table, you wouldn't get to count the dining room as a business use because that room doubles as a dining room for the rest of the time. So we're only talking about spaces that are devoted to the business entirely. So if you have a spare bedroom that has been renovated into an office, then absolutely you can use that whole room in your calculation. If someone still sleeps in that bedroom, then you can only use the area where the desk is in the calculation. It's a very simple calculation. During the year, you are saving up all of your house expenses. So it's listed here, but what we're talking about is mortgage interest and not principal. If you're renting, it would be your rent, your utilities, property taxes, strata fees, insurance, that home telephone charge, if you want to take a percentage of your home phone, that percentage relates to the percentage of your home that's being used for business. So if you have a 2,000 square foot home and you're using 200 square feet, then the percentage that you would be allowed to claim would be 10%. If you're a GST registrant, you can also claim 10% of the GST on all of your home bills as an input tax credit. Just a warning that this is an audit trigger. If you're claiming, say, 35% of home business use, you're probably going to get a visit from CRA. They'll want to see the setup of your home to make sure that it really is 35% used entirely for business. I do know one client who claimed 90% business use. CRA paid her a visit and it was actually accepted because she runs an art gallery out of her entire home. So think of the tax benefits there in terms of all of the home expenses that she actually gets to use to draw down her taxable income. Cost of goods sold, I'm just going to buzz through. I had already referred to the fact that if you are selling a good, that you have product in inventory, that you are not allowed to claim that as an expense until the year that you sell it. So this section of the handout details that reality. If you're just a service business, like a bookkeeping business like my own, I don't have inventory because I'm selling a service and not a tangible item. I would like to circle back to any questions I haven't answered just as soon as I finish talking about motor vehicle expenses. Most of us don't have the luxury of a business vehicle and a personal vehicle. We have a single automobile that we're using for both personal and business use. The same philosophy applies as for home office, where we are taking a look at our percentage of business use for our vehicle. So instead of square footage, it's kilometers. What I do is I keep an envelope in my car throughout the year and I just put my gas bills in that envelope and I forget about it. So all of my repairs and maintenance, I might have a second file in the house that has my car insurance. And at the end of the year, I bring everything together and get a total. I don't get to write all of that off because, of course, I'm also using the car for personal use. But I would keep a logbook in my car that logs my personal kilometers. So I bring my book into the house at the end of the year and say I have 1,000 kilometers once I add up my logbook. But looking at my odometer reading at the end of the year versus the beginning, I've driven 2,000 kilometers. So that means I get to expense 50% of all of my motor vehicle expenses. Likewise, if I'm a GST registrant, I would get to claim that percentage in input tax credits on my GST. We never know this amount until the end of the year. So unlike business use of home, where we more or less know what square footage we're working out of, we don't really know what our motor vehicle expense percentage is going to be until we add up our logbook and compare it to our total kilometers driven for the year. Very briefly, unless you're a farmer, we're using what's called the accrual method of accounting. This is a really important approach to remember when you're collecting your bills throughout the year, is that we're concerned with when the activity happened, not when the money flowed for it. So for example, if I make a sale this month in December and I'm not paid for it until next month, which would be next year, I still have to claim it as income this year because that's when the transaction happened. But it works both ways. So if I purchase a printer cartridge in December and don't pay for it on my credit card until next year, I still get to claim it as an expense for this year because that's when the transaction happened. To make things a bit more complicated, with the self-employment reporting program that I mentioned at the very beginning, they operate on a cash basis. So they're not looking at this accrual method. They're looking at when did you receive the money from the sale, or when did you pay for that printer cartridge in real time. So it's a little bit of a head shift if you're reporting for that program, because you can't directly use the same numbers that you're using for your tax reporting. What I've given you today is a snapshot or a translation of the most common expenses that you would be using as a sole proprietorship. I've given you a listing here of a web page on CRA's website that gives way more detailed information, and also that link that I promised about bringing personal assets into a business and how to evaluate them. There's a question here that I see around business computer for business use only. I use the same philosophy as I do for the internet, and that is that I need a computer to run my business, and that the personal element of it is incidental. So any expense that's related to running my computer or putting ink into my printer, I write off in full as a business expense. You're not going to find one way or the other in CRA, but CRA's general philosophy is that your approach be reasonable. And that, I think, is a reasonable approach to handling internet and computer expenses. Are there any other questions? Marie has a question. Michael has a question. They're typing feverishly to get those questions out. Okay. 2125 with two businesses. Yes, so as I said earlier, I run two businesses. So I run two 2125. So I run two separate worksheets, two separate 2125s. And if you're using tax preparation software, you'll see that you can run as many of those 2125s as you like, and everything gets totaled and brought onto the jacket of your yes, with TurboTax, absolutely. How do I deal with or record gift certificates that I issue? I'm so glad that you asked that question. Most folks assume that if they're issuing gift certificates for their good or service, that is somehow an expense. Let me give you first an example of a service business. As a bookkeeper, if I gave you a gift certificate for my work, say you get 5 free hours of bookkeeping, there's really nothing to expense there. It's my time. It's a promotion, but I didn't pay for that. So I wouldn't put that on my promotion line. It cost me nothing. It's really just costing my time. So you might want to keep track of your gift certificates, but they don't really, somebody will take the free 5 hours here. You don't really record that as an expense, time that you're giving up, but that it's not a monetized contribution. Let's put it that way. If you're selling a good, so let's go back to the candle company and I give you a gift certificate for 5 free candles, I'm already expensing those wicks and the wax and the items that I use that go into that candle within my inventory. So that's already taken care of. There's no extra expense there. So it would only be expensed if you purchased a gift certificate, say from another company. So say I bought, and I do, Starbucks gift certificates, gift cards for my client. In that case, I would expense that as a promotional item because it was money out of my bank account. So you probably, that's like a counterintuitive response to your question, but that is the reality because it's a gift certificate for your own good or service doesn't represent an extra cost to you. It's already, if it's a good, it's already being reflected in your business. And if it's a service, it's no extra cost. So again, comping rooms for a B&B, I would argue that it's not an expense. Any cost associated with comping a room for a B&B, such as the food that you're serving and the utilities in your house, are already being recorded in your income tax as a supplies expense, as a business use of home expense. So there isn't anything extra for you to record there.
And we've got this one question from John, and it's about supplies brought into the business. Stacey, it's just above Marie's question. Could you address it?
And sorry, what is the question? Oh, okay. Supplies that I own before my business. Yes, so that is correct. You would take a look at that final link in the handout for information on bringing personal assets into a business. And that would help you arrive at the fair market value with which you're going to bring that item into your business. And then over time, you would amortize it. Again, that's only if the supply is more than $300. If it's less, you can expense the whole thing in the year that you bring it in. Can you prepay expenses for 2014 and claim for 2013? Very good question, and no. So an example would be, right now I've already paid my business license for 2014 because that's when the municipality sends out the invoice. So when I post that, if you're using bookkeeping software, it's a prepaid expense. So it's sitting in my balance sheet as an asset, and I don't actually expense it until 2014 when the expense comes into force. Now, one thing you could do is say you could buy a whole bunch of business cards or office supplies. If you're actually taking possession of that item this year, you could think about expensing it this year. It's a bit of a gray area, but definitely if you've prepaid something and you haven't taken possession of it, that would be a 2014 item, because that again flows back to the accrual method of accounting. Newspaper will give receipt for ads. Okay, so that's your example of prepaying. So no, you would, because you're receiving benefit from that ad, presumably in 2014, and that's when you get to expense the ad. Sorry about that, don't shoot the messenger.
We're at 1 o'clock right now, Stacey, so we've got time for perhaps another quick question here.
The receipt wouldn't state the dates of the ads. Okay, so this kind of reminds me of when this is a joke, I'm joking here, but when I used to teach bookkeeping in prison, I'd always have the inmates trying to find the workarounds. So if the receipt doesn't state the date of the ads, that's your call. You can do as you choose. I'm just kind of stating with the accrual method of accounting that technically you wouldn't be able to write that off until 2014, but govern yourself. John, you're very welcome, and thank you for your kind words.
Well, thank you, Stacey. We're at 1 o'clock right now, and it was much appreciated by myself. And I want to remind the attendees that this file will remain up. You can click on the link later on today and over the next few weeks. And if you look at the bottom of the screen, we have web links. Those are the links that Stacey told us about. And on the right side, it says Files 2. You've got Stacey's workbook there, Tax Tips for Sole Proprietors, that you can download. And you can also download Form T2125 for 2014 right there. So thank you very much again, Stacey, for helping us recognize December 3rd, International Day of Disabilities, and for all those tax tips.
Thank you very much.
Great. Thank you again, and thank you everyone for joining us. Have a good afternoon.